Hello, friends. Today we're taking a look at Kimberly-Clark Corporation, ticker symbol KMB. We'll be looking at the stock performance in the last 5 years. We'll look at the current news, the latest earnings report, try to figure out why it dropped 5% last week, and then we'll jump into the last 10 years of fundamentals, including dividend history, and we'll, of course, try to find a fair value. Welcome to Money Talks with Martin Reyes, where we learn to take care of our money and find great companies at great prices. In the last 5 days, KMB is down almost 2% after dropping 5%. It has recuperated a little bit. In the last month, it's flat. It's almost up, almost a 0% up. In the last year, it's down 6.2%. And the last 5 years, as you can see in the graph, is just bananas. It has it's just up and down. It's just moving sideways. It is up 12%, but that's because it came from a lower. So when it comes to the analysts looking forward in the next 12 months, they think that they have put a target price, a consensus target price of $131, which is about an 8% upside. And if you pair that with the 4% dividend, that will give you about a possible 12% in the next 12 months. Not bad, but I guess that's what we're going to try to figure out. Is this something that we will want to jump in and get a reliable defensive stock at 4% dividend? The 52-week low is at $116, which is not that far away from the price today. The PE ratio, it is, in my opinion, a little high, very high at 35, although the forward PE is at a fair 22 PE. So with that said, let's jump into Kimberly-Clark. For those that don't know, they pretty much focus on cotton products or paper products. It's a big company. They have a lot of adult care products. They have feminine care products like actually, I don't know most of the. Sorry, I don't use this product. So, Kotex and Camilla. Also, they have a lot of. They have paper, like paper towers and paper, toilet paper, and also they have the professional side of that. In the last earnings, which was last week on Wednesday, they missed on EPS and they also missed in revenue. Even though they made more money than they made last year, the analysts were expecting almost 5 billions, which is 4.97 billions, and they missed by 23 millions. So EPS is down. Some of the reason that they gave why they are down, it has to do with a lower on organic sales. Also, they sold some kind of company in Brazil, and they blame most of it on the exchange rate of the dollar. So that is some of the different issues. Personal care, they were down almost. They were down only 1%. In tissue, organic growth on the professional was down quite a bit. Organic sale was down 2%. Although they did mention that in Australia and Asia, their numbers were much better. Next earnings report will be on April 22nd, and so far they have been receiving 14 downgrades in the last 19 days, 90 days, which I think that has to do mostly with the downgrades to this earnings. So, with that said, if you like so far what I am sharing with you, please leave a like and subscribe in the channel or the podcast. Also, leave a comment or a question or a suggestion. Let me know what I missed, what I mispronounce, your bull case, your bear case on this talk. Let's just jump right into my spreadsheet and discuss the last 10 years of fundamental. When it comes to revenue per share, it's in the last 10 years, it has grown 1.65%. It's very small growth. Actually, it is a little flat. The only reason why in this graph it shows a little bit high has to do with the outstanding shares. If we jump into the outstanding share, we'll see that the last 10 years they have bought back 1.2%. So that's going to affect a little bit these numbers. So revenue is kind of flat. Yeah, granted, this kind of big company has a hard time growing once they're so big, but growing at 1.6% in the last 10 years, or even 2.5 in the 5th year, I personally think that there might be other growing companies, especially if you're an investor like me that is looking for growth or value. This is not the kind of numbers that I'm looking at. Well, maybe they're better at earnings. Well, no, they're not. First of all, they're cyclical. Even though they're considered defensive, their earnings are very cyclical. Has to do with the price of cotton, the price of paper, so all of those commodity. It kind of affects their bottom line. In the last 10 years, they're actually negative when it comes to earnings, or kind of flat. Yes, in the past 5 years, they have gone up to 5.23%. Free cash flow, once again, it just goes up and down. It's been growing about 2.7% in the last 10 years, which is not that amazing. Book value looks horrible. I'm going to be honest with you. I do not understand why these numbers are like this. So if you were to want to invest in this company, I will encourage you to look at their balance sheet and dig into it. I know that I'm not going to be investing in this company. I'm just letting you right now. I'm letting you know right now because of already the numbers. So I didn't dig in too much. Return on equity is at 10. It's crazy numbers, and I don't understand why these numbers are also so high and they're not making almost any money. Return on asset is at almost 11%, and return on invested equity at close to 24%. When it comes to dividend, I have not updated my my sheet, but they just announced an increase, which will put this at $4.88. But it has been growing close to 4% in the last 10 years. So if you're a dividend investor, this might be a reason why, although you probably already know that there's other companies that could give you a better dividend for your money. Plus, the payout ratio is pretty high. When it comes to debt, I thought that the debt was the problem. Maybe my calculations are wrong, and if you have another perspective, please let me know. They could pay their long-term debt in 3.5 years, which will make them debt safe for me. Once again, when I talked, they're buying back shares at 1.2%, which I think other companies are doing a better job with that. Analysts are thinking that they're going to grow 9.3% in the next 5 years. I don't see how, but maybe I am wrong. I'm probably wrong. So whenever I was looking at the historical... Oh, before we jump into valuations, let me just give you a disclaimer. I am just a YouTuber. I am probably wrong in everything that I'm telling you. So this is just for entertainment and educational purposes. I am not a financial advisor, so do not make financial advice based on my opinions. Uh, as you can see, I am very excited about this company. I'm sorry. I'm trying to make the channel a little more conversational. And let me know if you like it or if you just want me to stick to the numbers. So, in the historical multiple valuations, we're looking at a price close to $132 to $142. When it comes to payback time, this is taking the free cash flow and growing it at 2%. I use 2% because that's what I kind of saw here, what they're growing at. It will give us a fair value somewhere between $115 to $142. Discounted earning valuation. This whenever we grow the earnings at 2%, multiply in the future for 5 years, then multiplying for the average P in the last 10 years of 23 gives us these numbers, which then I discount back at 15%, which is a little higher, but that's what I require. So if I wanted to recuperate my money in the next 5 years, I will have to buy these stocks somewhere between $65 to $70. That's why I'm not going to be using it in the final sheet. When we use owner earnings valuation, we're looking at somewhere around $128 to $137 of fair value. This is from Warren Buffett. And then our fair value, when we put all the numbers together, it gives us somewhere around $130 to $140, which is kind of where it has been trading in the last 5 years, somewhere between 112 actually and 140. So the fair value, it's staying somewhere around $135. So when it comes to a margin of safety, like I said, I'm not going to be purchasing this company, but if I were to maybe consider it for a trade, let's say that it dropped 15%, so buying it somewhere around $115 might make sense if you think that it's gonna go up to the 135, and then while you wait, you collect a 5% dividend. Maybe for you that makes sense. Maybe like a swing trade for less than a year, somewhere around a year, that can be something to consider. I will probably, as a margin of safety, because of the numbers, the slow growth, I will be looking for a big drop, somewhere at about 20%. That way, if I have to wait a little longer, yeah, I just in case my numbers are wrong, 108, that will be somewhere around what I'll be looking at. Well, I hope that you liked everything that you saw. If you liked the sheet that I showed you, the Excel sheet, you can go to Buy Me a Coffee, where you can get the spreadsheet there. Also, you can support the channel over there. Please leave a like or a comment, whether it's in YouTube or podcast. Let me know how I did, and I hope to see you next week.